Welcome back to Investing Talk Podcast.
Today we're looking at Broadcom.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Broadcom is, it's a fascinating story right now. It's really transformed itself over the last few years, especially with this huge AI infrastructure build out.
It really has. I mean, our goal today is to kind of cut through the noise, right? We see these spectacular numbers, but the real question is it sustainable? And, what are the big risks that could derail this momentum?
Exactly. And when you look at Broadcom today, you're really looking at a company that has built this twin engine growth story. The scale they've achieved it's just massive.
The numbers are almost hard to believe. I mean, what are we looking at for the full year?
Well, the latest forecast for their fiscal 2025 consolidated revenue is projected to hit $64 billion.
$64 billion.
Yeah, and that's up a whopping 24% year over year. For a company that size, that's practically hypergrowth.
And it's not slowing down. The recent numbers, Q4 2025, that was a record $18 billion. And the guidance for the next quarter is even higher at $19.1 billion. It feels like it's accelerating.
It is accelerating, and that's the key signal, right? The conditions driving this are getting stronger, not weaker. And if we look inside that twin engine, you can really see where the excitement is.
It's the AI chips. Has to be.
It's the AI semiconductor space, yeah. Specifically, their custom silicon. We should be clear, though, they're not just selling, off-the-shelf parts.
Right.
Their AI semiconductor revenues surged 74% year over year in the last quarter to $6.5 billion. And that's coming from custom ASICs.
Application-specific integrated circuits.
Exactly. These are, unique proprietary chips they're building for the biggest players out there, the hyperscalers, your Googles, your Amazons, your Metas. They need this custom silicon to run their massive AI models efficiently.
The thing that jumped out at me, though, was the ambition. It's one thing to ride the wave, but they're projecting, over $120 billion in AI revenue by 2030?
It's a staggering target, a six-fold increase from where they are in fiscal 2025.
So how do they get there?
Volume. It's just sheer volume. The data shows that in just one quarter, Q1 of fiscal 25, they shipped something like 20 million AI-related ASICs. So this isn't a small bespoke business anymore. It's mass production of the essential plumbing for the world's biggest AI factories.
Okay, so that's the high growth, maybe high risk hardware engine.
Yeah.
Let's talk about the other engine, the one that provides the stability, the software business.
Infrastructure software segment, yeah, and it's absolutely the anchor here. They've built it up through some huge acquisitions like VMware.
And that brought in, about $6.9 billion last quarter?
It did. And you have to understand, this isn't consumer software. This is mission-critical stuff. Mainframe security, enterprise cloud platforms. The things huge companies cannot live without.
Which means it's predictable revenue. How do we quantify that for people listening?
The key metric is the net dollar retention rate. In Q1, it was 114%.
Wow. Okay, so break that down.
It means that not only are they keeping all of their existing customers, but those same customers are, on average, spending 14% more than they did the year before. It's an annuity, a predictable cash stream that smooths out the ups and downs of the chip business.
And that cash flow lets you build a serious competitive moat, which I think is the next logical step here. How are they so profitable?
Well, it all comes down to vertical integration. They're not just selling one piece of the puzzle. They're basically the full stack AI infrastructure company.
So they control everything from the custom chip to the
high-speed Ethernet switches, like their Tomahawk line, the controllers, RF components, and now the whole software layer on top. It's the entire ecosystem.
And that creates the lock-in.
A massive lock-in. The switching costs are just enormous. I mean, think about it. If you're a hyperscaler and you design your entire multi-billion-dollar AI data center around Broadcom's chips and switches,
you can't just swap them out.
You're looking at an estimated 18 to 24 months of a complete re-architecture to change suppliers. One report had a great line for it.
What was that?
Broadcom's chips are the plumbing of AI data centers. You don't change plumbing mid-build.
That's a perfect analogy.
Yeah.
And that lock-in has to translate into some pretty spectacular margins.
It does. I mean, their gross margins are consistently in the mid-70% range, but the operating leverage is what's truly incredible. The operating income margin recently hit a record 50.9%.
Wait, so for every dollar of revenue, more than 50 cents is dropping down to operating income?
50 cents. It's just an incredibly efficient machine, and all of that leads to their real superpower. cash generation.
Free cash flow.
Yep. Adjusted EBITDA was $43 billion in fiscal 2025, but free cash flow, the real cash they can use, was $26.9 billion. That's up 39% year over year.
And some analysts think that number could triple by 2029.
The street is looking at a potential FCF of around $94 billion by fiscal 2029. And that massive predictable cash flow is what lets them handle the debt from acquisitions and still invest billions in R&D.
Okay, that's a really strong bull case. But you can't have this kind of run-up without some serious risks. We have to look at the bear case.
Absolutely. And there are two big ones that always come up. The first is customer concentration.
Right. This AI boom is really just a few massive companies building everything.
Exactly. Their top 5 customers account for 42% of total revenue. So if even one or two of those hyperscalers decides to pull back on spending for a couple of quarters,
Broadcom feels it immediately. It's a huge risk.
it is. But that's where the software cushion is so important. It's not just a talking point. It's a financial firewall.
So how does that work exactly?
Well, the enterprise software business, it's non-cyclical, it's annuity-like, and while it's only about 12% of total revenue, it generates an estimated 75% of their total EBITDA.
Wait, hold on. Say that again. 12% of the revenue brings in 75% of the recurring profit.
That's it. It's an incredibly high-margin, stable segment that provides a financial floor. It's the money that keeps the lights on and R&D funded even if the big AI customers pause for a bit.
Okay, so that's a pretty strong defense. What's the second big risk?
It's valuation. Simple as that. The stock has had a huge run, and it's trading way above its historical average multiples. If that AI growth slows down even a little, the stock is vulnerable to what we call multiple compression.
Meaning investors just aren't willing to pay that premium price anymore.
Exactly. It's a crowded trade. But management has been smart about the structural risks. Yes, they have a lot of debt, but their net debt to EBITDA ratio is a manageable 1.8x. That's pretty strong.
And they have a good track record of absorbing these big acquisitions, right?
A very strong track record. They did it with CA Technologies, with Symantec. They're ruthless about optimizing assets and improving margins. The market is betting they can do the same thing with VMware.
And it looks like the insiders are betting on it too.
They are. The company returned $17.5 billion to shareholders last year. But the real tell for me was the CFO's share purchase back in March.
The $7.2 million buy, that's not a small gesture.
It's their largest insider buy since 2020. That's a huge vote of confidence. And it's not just him. We're seeing billions in net inflows from big institutions this year. The smart money is buying in.
Okay, so let's look ahead. What are the big catalysts, the dates we need to circle on the calendar?
The most immediate one is the Q1 earnings release. That's scheduled for April 29th. And the market is going to be watching two things like a hawk.
Which are?
First, the AI revenue growth rate. Can they keep that incredible momentum going? And second, the guidance for Q2. They need to show continued acceleration.
And looking a bit further out.
The big one is the Investor Day, probably in May or June. That's where we expect them to lay out their AI ASIC roadmap all the way through 2028.
Giving their customers visibility for years to come.
Exactly. And we're also expecting them to demo their 1.6 terabit Ethernet switching chip, which would be an industry first, and just cement their leadership in high-speed networking.
But what about M&A? Or even just rumors?
Well, they just closed a big deal, the $6.1 billion acquisition of Velis Technologies.
I feel like that one flew under the radar a bit.
It did, but it's strategic. Velis helps optimize the big AI models that run on Broadcom's hardware, so it just makes their whole stack stickier. It bridges that hardware-software gap.
And the rumor mill. Anything worth watching?
There's persistent chatter about a big deal within the OpenAI ecosystem, which would be massive. And another total unconfirmed rumor about a multi-billion-dollar deal with a big auto OEM for vehicle-to-cloud ASICs.
For autonomous driving. That would open up a whole new vertical for them.
A huge one. And it would really help with that customer concentration risk we talked about. It would give them a third powerful engine for growth.
So when you put it all together, it seems like Broadcom has successfully made the shift from being a traditional chip company to this full-stack AI infrastructure provider.
That's the story. And they've got that solid software business as a safety net. The test for them now isn't about demand, it's about execution. Can they integrate VMware successfully and keep delivering on these huge AI investments? If they can do that while keeping those 50% plus operating margins, well, that combination should be very rewarding for long-term investors.
If you enjoy this analysis, make sure you hit that subscribe button to catch our next one.